The S&P 500 is trading at all-time highs, up more than 80% over the past 5 years. On paper, we're witnessing one of the greatest bull markets in history. But if you look at the people actually powering this economy, the data tells a story we haven't seen since the 2008 financial crisis. Consumer sentiment has been in a free fall, dropping by nearly half in that same window to 2008 levels, and breaking a decades-long relationship. For decades, sentiment in the stock market moved in unison, but not anymore. That relationship broke down after the pandemic, and they've diverged ever since. It's a divergence that suggests one side of this equation is lying. Either the stock market is hallucinating a recovery that isn't there, or the average American is about to be left behind by a permanent shift in how wealth is created. Because right now, the economy is splitting in two. One half, the stock market, is booming, while the other is just trying to keep its head above water. And cratering consumer sentiment is a major weakness for the US economy. That's because nearly 70% of the US economy is made up of consumer spending. So whether or not regular people are spending or saving can make or break the economy. And today, the average consumer is, by almost every metric, struggling. After the pandemic, the lowest income percentile saw their wages rise faster than any other group for a couple of years. But since that wage growth peak in 2022, that story is reversed. Every income percentile has seen declining wage growth rates since the peak. But year-over-year wage growth for the lowest earners have sagged to 3.6% compared to 4.6% for the highest hourly earners. Real income growth, which accounts for inflation, paints an even starker picture. It currently sits under 2%, levels reminiscent of the early 2010s when the unemployment rate was 7% and the economy was still recovering from the Great Recession. Much of the wage growth that the lowest earners did see was rapidly consumed by the rising cost of housing, food, and energy, which have contributed to a small but concerning uptick in across-the-board inflation. Rising costs and slow-moving wages have nearly wiped out the record-level savings that consumers were able to build up during the pandemic, putting the average American consumer in a vulnerable position, near the lowest savings rates on record. And as consumers have dipped into and depleted savings to cover necessities, they've inevitably taken on more debt to cover daily costs. Debt payments as a percentage of disposable income have risen quite dramatically since late 2020 for mortgages and other debt. This increase is driven by higher interest rates, which directly impact the cost of loans and credit card payments for consumers. Judging by the poor state of the average consumer, you'd think that the market must be on the verge of a total crash. If the people who drive 70% of GDP can't afford their lives, the earnings of the S&P 500 should be cratering, but that isn't what's happening. The S&P 500 rose more than 16% in 2025, and by many other metrics, the economy has proven to be resilient. Credit is actually improving, and defaults are falling, despite rising payments. That's a sign of financial health in the economy. The reason defaults remain low, even with rising debt payments, is that Americans still have jobs. They're using their paychecks to service ever-increasing debt loads, a trend supported by low unemployment. The unemployment rate has been ticking up over the past few years, rising to 4.6%, but that is still within the 3 to 5% range considered full employment by the Fed. And initial jobless claims have not really been climbing, which indicates more of a hiring freeze than a firing frenzy. And at the same time, a growing number of S&P 500 firms are announcing rosier earnings projections. This indicates that despite the bifurcated economy we're seeing, there are some optimistic signs that things could be improving. And to top it off, despite a strained consumer saddled with debt, retail sales have shown solid growth lately. At first glance, this doesn't seem to add up. If the average consumer is struggling so much, who's holding up the economy? The data shows we might be looking at the wrong consumer. While we talk about the consumer as one group, the economy is split in two, and it's the wealthiest consumers who are spending the most. The top 10% earners accounted for nearly half of all consumer spending in Q2 2025, the highest level since records began in 1989. Meanwhile, lower and middle income families are tightening their purse strings. The ultra-wealthy are also much more exposed to the stock market. The top 1% own half of all equities in the US, while the bottom 50% own just 1% of stocks and rely primarily on wages for their income. The S&P 500 has grown nearly 50% over the past 5 years, minus inflation. Meanwhile, wage growth has been stagnant over that period when you account for inflation, so a tiny fraction of the population benefits enormously from the rallying stock market compared to the average consumer who may struggle to pay rent and likely doesn't own any equities at all. This means the stock market rests on the continued spending of the wealthy few, who are benefiting largely from a rising stock market. As long as the top 10% keep spending, the engine keeps turning, but this has turned the US economy into a fragile tower.
That's about it on so the names that were hit the hardest, many growth names, Tuesday or Friday had a monster bounce. And I'm talking quantum. Quantum has been on Team Bear. Big tech, semis to a certain degree, software, and many growth have been the things that have been weak. And so IONQ dropped down and hit the lowest level that we've seen in years, or at least a year. So that's significant. But again, monster, it doesn't look like much. This is why I always favor looking long compared to shorts. This monster drop is 36%, and this one-day bounce is 20%. It's just so much easier for bulls to get a much bigger piece of the pie percentage-wise versus what bears do. So we're going to look for daily lower highs in these names, but again, just uranium names, SMR. Again, big drop, big 2-day drop, down 18%, and then in one day, you're up 21%. So can SMR form a weekly higher low and shape up an inverse head and shoulders? We'll see. Okay, a low monster day on Friday after a lot of weakness on the way down. But again, still daily downtrends there. One thing that I'm watching for, I took some more profit in CCJ as well in uranium. Uranium pulled back, but we're going to look for weekly higher lows here. Back testing previous all-time high resistance as support, 110. Holding it initially, but so I'm just sizing down the swings that have been working. And again, just watching for that next shift in rotation. All right, metals. So dollar, daily stair step down. Daily stair step up just broke. Can the bears follow through? If we get another pullback to start this coming week, we're going to look for an equilibrium on the daily chart for the dollar. But the metals have been great in terms of volatility. Last week in the video, talked about how once we find a low, we're going to look for an equilibrium because that's where the way it goes in volatility. And look at gold, just a perfect 12-hour equilibrium. We had the monster flush data end last week after historical overbought RSI levels marked the top on gold. That's something Joey was talking about in our Thailand interview. But just a beautiful equilibrium. And all in all, the bulls are just fine. Yes, it was a lot of volatility, yes, it was a big drop, but the bears have not proven a thing. Look at weekly EMA 12. Those of you who've been watching these videos for over a year, we've literally been talking about weekly EMA 12 on gold for over a year. If this is support, bulls don't have anything to worry about. Beautiful hold yet again. It's just been the forever bull guide of this metal. And so if this 12-hour equilibrium breaks bull, bulls are still in complete control. So we'll see the direction that this breaks. The setup, one of the things I often do when I'm using correlations as a factor in my trading is I look for something that the leader does, and then how's the smaller name going to respond to it, whether it's Bitcoin and an altcoin, whether it's gold and silver, whether it's the Nasdaq and Tesla. And so there was a setup here where we were looking for, so the bounce we had on gold, retracement size was big enough to tell us the most likely scenario is an equilibrium. 50% plus bounce retracement. Google Chart Guys Fibonacci for a whole video describing this. It's a very worthwhile video and concept. So we knew to be scouting the equilibrium as soon as that was that bounce retracement. Silver had a much weaker bounce retracement, and that left a bear flag on the table, 382. Anything under 382 retracement is a potential bear flag. So there was a scenario saying, okay, we could see silver bear break with no follow through. Because if silver bear breaks and gold forms the higher low for the anticipated equilibrium, silver bears won't follow through. And so that was a setup where one of the things I was talking about with Joey, you're going to look for the metals daily bounce, 70 break, no follow through would be sweet. And that was the setup that I was looking for. Why 70? Because 70 was a base on the way up. We defended this 70 zone here. We defended it on the initial flush. And so I was looking for a bear break of that level with no follow through. We broke it for an hour and a half and then popped right back above it. This is why trading is hard. I had the setup, everything, what my anticipation was. I know the gold most likely scenario. I'm watching for silver to bear break, no follow through, for that to potentially mark a weekly higher low. And again, silver can easily trade within range. We're going to set a range on silver that we'll trade within for months. And whether that's happening right now, bulls still need to prove it. But we're going to look for something like that for a long time. But not yet. We don't have confidence the bottom's in just yet. Same thing as the futures. Bulls still need to confirm the uptrend on the 4-hour. And silver and the Nasdaq have been very correlated recently. If you look at, they're the same charts many times. Look at Thursday, hourly EMA 12 rider on silver, and the Nasdaq hourly EMA 12 rider, Thursday and Friday. And then we bottom, silver bottoms at 7 p.m. Thursday night, Nasdaq bottoms at 7 p.m. Thursday night, bounce the entire into Friday. They're the same charts. I've actually used the correlation with the Nasdaq for some clues with silver to help with my short-term trading. So that's going to fade eventually, but it's very prevalent right now. So what I was going to say is trading is hard because I've got all this laid out. And then, Thursday night I'm doing my routine, which is sauna, cold plunge, and then I'm in the shower. And I'm putting music on my Bluetooth in the shower and I see silver in free fall. And I see the 5 and the 15-minute RSI on silver hitting some historical extremes and just getting absolutely smashed on that 70 break because you trigger a bunch of stops and so you just rapidly follow through. And so I'm in the shower scrambling. I don't usually trade from my phone, but I was like, all right, this is extreme. And I was trading SLV and I got a fill at 60.36 or something like that. And then my second fill was the bottom. It was 58, 80, whatever. And I had great fills. And then we get I was just looking for a 15-minute oversold bounce. So because I was unprepared and I'm naked and I'm wet and trading, I was just trading this as a 15-minute bounce and then looking to just lock in the profit because I was very confident that a 15-minute bounce was coming. So,
and get this, the US government is spending $2 trillion more per year than it takes in, which is just bananas. But here's what makes it worse. Companies like Nvidia are worth like $5 trillion now, more than most countries, and just 7 companies, 7 out of the S&P 500 companies are responsible for almost all market gains over the last 12 months. And these deficit numbers seem abstract. Like, what does it matter? It's $1 trillion more or less. You know, what is that between friends? Well, it's as if you are the average American household, it's like spending $266,000 more per year than you earn. Imagine putting that on your credit card year after year. How long do you think you could keep going before, well, the house would fall apart? But this isn't the first time we've seen this pattern, and that's why I'm a huge believer in studying patterns and where the money flows, because it leaves great big giant elephant footprints, even larger than Winston's. So let me take you back a little. In the 1970s, we had something called stagflation. That's when 2 bad things happen at the same time to nice people. Prices go up and jobs go down. It's like getting sick and then breaking your leg at the same time, double trouble. Back then, the stock market fell 50%. So if you had $10,000 invested, you lost $5,000, and it took a very, very long time to recover. Are we in stagflation right now? No, not yet. But we are seeing early warning signs. Inflation looks elevated. Unemployment is rising. Same pattern we saw in the early 1970s. And then, just a little bit later, in 2000, we had the dot-com bubble. Everybody was excited about the internet, right? Dot-com was the latest thing, and stock prices went up on the basis of how much these companies spent, which is a little bit like what's happening with AI right now. But people then said, this time is different. And then, well, it burst, right? I was investing back then. That's when I just started. I started in 1999. Not the greatest timing, but maybe it was because it was a very early lesson which helped. Now, if you fast forward to 2008, they call it the housing bubble. I call it the credit rating agency fraud paid for by investment banks. But then I have a large imagination, and of course that wasn't the case, because credit rating agencies are honorable people who care about nothing but the wealth of the country and not their personal, brown envelope jobs. Those never happened, clearly. But what happened then is that banks were taking hidden risks that regular people didn't see, right? And if you go a little bit further into where we are right now, well, Silicon Valley Bank, a top 10 US bank, collapsed in 2023. That shocked everybody. I remember I was in Marseille, which is a really, really horrid place in the south of France that used to be nice once and has now been overrun by, you're not allowed to say that anymore, are you? But they have an issue that is pretty significant. Now, every time we've seen markets rise while fundamentals weaken, history shows us the same pattern. Eventually, reality catches up with us. So the question isn't if, but when. So what's the solution? Well, most people think we can just solve this with traditional approaches. Well, let me tell you that each one of those does not work. And why? You could print more money. Yes, you can. That leads to hyperinflation. They are going to print more money, quite a few trillion more. They keep doing that. They enjoy it. Maybe you don't believe me. Just type M2 and Fred into Google. I don't know who Fred is, but he seems to be the guy who's got all the data. It's the Fed's data depository. And this is how much money there is in dollars, right? So if you think this won't cause inflation, well, you should apply for the Fed chair, although the mole I think just got filled, because you are a lunatic. So when you go from, say, 2020, we had $15 trillion, and now we have $22 trillion. What happens when you add 7 trillion to 15 trillion? You've almost increased the amount of money by 50%. What do you think happens to the value of the dollar? There's 50% more of them, therefore, it's worth 50% less. That's sort of simple maths, right? And they're going to continue to do that. But they can't do it to the extent they'd like to, because then it would cause hyperinflation, and then we become Zimbabwe, and we all know how that turned out. You could cut spending, which means you lose your job if you're a politician by next Tuesday. So it's never going to happen, because would you vote for the guy who cut spending? In all honesty, you don't, right? The social security recipients would vote with their feet, and you'd be out of the door faster than you can say, Botswana. I don't know why I thought of Botswana just. You could default on the debt. Yeah, it would destroy the dollar's reserve currency status. It would be the end of the global financial system. No country would trust the US ever again. Could you raise taxes? No, you can't, because again, you get voted out of office and it wouldn't fix the problem. If you took all the money from every US billionaire at 100%, it wouldn't make much of a dent. What else could you do? Well, you could grow the economy, right? That's what Papa Trump says. Well, you'd need 8 to 10% GDP growth for decades. That's never ever happened in modern history. US did a little bit of that after World War II, but it isn't something that continues for a long period of time. So the reality is there is no traditional way out of this, but there is something happening behind the scenes. We've got Fed rate cuts, more incoming from the new Fed chair. It's medicine for a sick economy. We have an insanely concentrated market with only a couple of stocks holding up the whole thing. You saw what just happened when Microsoft coughed. They coughed out a little bit of Sam Altman, apparently. The whole ChatGPT, OpenAI, it just smells evil, doesn't it? I'm not saying it is. I'm sure Sam Altman is a stand-up guy and all that, but it just comes across as really evil. I don't know why. And then we've got insane government spending. So how does this work? Well, the Fed cuts interest rates. That means banks get cheaper money, and that means they lend more easily. So companies therefore get more money. They're going to buy back their own stocks. And consumers spend more because consumer credit got cheaper. So you pay less for your car loans and your credit card loans and all the stuff you have on hire. Do people still do that? Hire purchase? Or is this like an 80s concept? Let me know if you're American in the comments down below. And all of this flows into the stock market. It's an artificial boost. And on top of that, you also have government spending. The government spends $2 trillion more. What does it spend it on? Well, services and companies and building things and weapons and more weapons probably. So all those dollars flow into companies, who then pay other companies who pay other companies, so it ends up in the stock market. So we have artificial support, the Fed, spending, general AI hype, and so the markets rise while the economy looks a little bit shaky. But there are warning signs. People are ignoring it, but you are smarter than that, so you're starting to understand what's going on here. First of all, inflation is a hidden tax, right? So if inflation were just 2.9%, official government number, then you'd be losing 2.9% of your money every year, right? Now, in reality, I think inflation is much higher than that, because there are things that have gone up a lot more than 2.9% last year. So if we look at QQQ, the Nasdaq, how much has that gone up by over the last year? About 89%? Can that be right? That's insane, isn't it? No, this is gold. Not a tech stock, it's gold. It looks like a mean tech stock, doesn't it? Well, that was a good example. The people owning lots of gold, who are the wealthy, institutions, the Fed, central banks, they're 89% richer than you. And that, I will tell you, will make other things more expensive, because these guys are now richer. That is inflation. Asset prices going up, it's in our inflation. It's not the price of milk or eggs or any of the nonsense they want you to believe. But even if you believed in this 2.9%, myth of inflation, over 10 years, your $100,000 lose $25,000 in value. Whereas if you invested in assets, you'd have $47,000 more. So altogether, you're still losing, what is that, $72,000 compared to the guy who was in the right thing. That is the wealth transfer. So who wins, who loses? Stock owners, if you're in the right stocks. Not all stocks, because look at the S&P 500. There are 7 winners and 493 losers, as your president likes to say. Real estate. It's the right kind of real estate. Commodities, gold, silver's done insanely well. I think will likely continue to. If you've got in savings accounts, you've got fixed bonds, you've got cash, you've got those duff stocks, then I think you're in trouble. So what's our solution here? Our solution is one, don't put all eggs in one basket. It never sounds particularly sexy. Everybody always wants to be in the latest thing, but the AI thing, I think it's going to be great. It's going to be amazing, but it's going to take way longer than you think. And we're going to have a period where the market is disappointed with AI, and then it's going to go back up again. So you're going to look at your horizon. Are you retiring next year or in 30 years, right? That'll impact how you decide what to do with it. So I would have AI exposure. I do. I own tech stocks, absolutely. But I also diversify into other things, certain financials, metal stocks, biotech, solar. All those sectors are doing very well right now. Now, will those sectors be still the ones I'm holding in a month or in 3 months whenever you're watching this? No, not necessarily. So learn yourself the rules so you know better where to put your money, and you can do that at felixfriends.org/get-free. But the goal is always, if the latest thing pops, you have other holdings that will actually go up when those go down. That's what we do. So corporate bonds can be a good place to be. Some of them pay 7% with relatively reasonable risk. Again, I'm not a financial advisor, you got to come to your own conclusions. Short duration bonds can be a good thing for those emergency funds and so on. Long maturity bonds, generally a terrible place to be because inflation could destroy them. So what do you want to have? Look, we're going to have some money in an emergency fund, right? Put that into a high yield savings account. It's sort of dead money, but it is there if you ever need it. Now, could you put that into gold? Yes. But if you really want to access it, you're probably going to pay a premium to sell it quickly. We're going to have some real assets, gold, silver, real estate, if it's within your price bracket. And those are an inflation hedge. Those protect you if the dollar keeps losing value, which I believe it will, new Fed chair or not. And just avoid this, what I see so often. I've seen thousands of people's portfolios, and it's always like it's 100% in the latest thing. I'm like, you're taking so much risk. Or they have 98 stocks, but they're all in the same sector. I'm like, just buy one, or buy the sector, or buy three. Don't make your life so complicated, right? But the worst thing to do, in my humble opinion, is to wait for the crash. Because given what the government's doing and how much money it's spending, I don't think there'll be a crash. And that's my humble opinion, which Winston's willing to back up, aren't you? Winston? Not much support, is it? No. Thought I could count on him. Oh, never mind. And let me give you one more bonus rule, particularly if you watch the mini masterclasses, will help you. If your position is up a lot, right, set a stop loss somewhere. It could be a break even, it could be 10 or 15% below, or 6% below, depends on what you hold. You could learn about ATRs. There's a lot of stuff to that. There's layers to that knowledge. But the key is to never let a winner become a loser, right? I have losing stocks. For example, I bought United Health. It went up, I don't know what, 15%, and then it went down again, and I exited with a small loss. Why? Because I'd set a stop. I didn't have to think about it. When it collapsed, when it crashed, a rule got triggered, and it's out of the portfolio, and now there's a nice bit of cash that I can then reinvest. So we don't ever want to allow something to become an anchor, right? Tied around your ankles as you are swimming in a sea full of sharks, which is pretty much what Wall Street is. Now, the new Fed chair is going to be an interesting one. If the Fed becomes really supportive and starts cutting rates frantically, I think we should be more in stocks and gold and silver. If the Fed becomes more hawkish, I would reduce my stock exposure, certainly the higher risk parts of the stock exposure. So you always want to be trade with the wind, and I will judge that simply by where the money is flowing, and by that I mean the institutional money.